Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is 10:30 UAE time on the 4th of September, 2024, and the new season begins. And welcome back to all of our regular commentators from last season. Really great to have you guys. Let's kick off with Vandana Hari as oil prices and Brent are closer to $73 now than 75. Of course, Vandana Hari, founder and CEO of Vanda Insights, well quoted all over the world, and most notably this morning on Bloomberg. And so I wanted to pick up on that peak panic mode, Vandana. Bloomberg are quoting you as saying financial markets in peak panic mode. Why is my question to you this morning?
Good morning, Sean, and good morning to everyone. I'll add another P to that alliteration. I think it's peak panic mode ahead of the highly anticipated Fed pivot. There you go, pivot, another P. So here's what I think is happening, Sean. So we know the last few months, demand and more precisely concerns over global oil demand have been dominating the scene, right? I think what happened yesterday in a lot of ways echoes of the August 5 market crash is that investors went into panic mode again. There was a lot of sell-off of across risk assets, not just oil, on fears of a US recession. And what seems to have triggered it specifically yesterday is the US manufacturing PMI for August coming in weak, of course, in contractionary territory where it's been for the past 21 months. But at 47.2 doesn't look very good. It was below analysts' expectations. And if you look at oil, fundamentals-wise, it doesn't have much support. We know that the Libya situation seems to be resolving itself. So there was really not much support for crude, but to get swept away in the tide of panic sell-off in the broader financial markets.
Let's go to Paris, where there's always a little bit of wisdom. Neil Atkinson, former head of oil markets division at the International Energy Agency, continuing on this sort of analogy that Vandana has shared with us, peak panic. Panic would sort of generally indicate overreaction with a bounce back. Your thoughts on why we're at $73? We basically gave up all gains this year on the oil price. There is silence. Neil Atkinson has been finally silenced. It's taken a few decades.
It's what everybody's been waiting for.
Headline, snap on Bloomberg, headline.
Okay, here's another P word, P-U-H. I'm not a panic person. I don't believe it is actually panic. There's it's a bit like a sort of deflating tire or a souffle collapsing gradually. Because all this economic data, which Vandana quite rightly mentioned, hasn't come out of the blue. The economic outlook and therefore its impact on oil demand, this pessimism, if you want to call it that, another P word, has been building gradually during the year. The relatively low levels of demand increase for oil from China is no great secret. We've been dialing back our numbers for China for a long time. Uncertainty over the US economy, the carnage that does seem to be taking place in the German industrial sector, and weakness in other places as well. So I don't see it as a panic. I think this is gradually the fundamentals are asserting themselves. And we are in a situation now that if you believe that the demand growth outlook is now significantly weaker than we thought just a few months ago, and the outlook is likely to be cut back as the agencies and the analysts produce further oil demand outlooks. If you do believe that, then that raises the question about supply. And of course, we are at this situation where our dear friends in OPEC Plus have a program to bring more oil back into the market. And it is very, very difficult to see in the current macro outlook how you can really bring in more supply to a market that basically doesn't seem to want it.
Jamie Ingram, senior editor at Middle East Economic Survey. Few people watch OPEC Plus as close as you do. What a sort of pickle are they in now? Or is this an opportunity to add barrels back to the market, which they've been wanting to do for a long time?
Hi, Sean. Good to be back after the summer. Yeah, I'm not going to throw any more peas into the mix, I'm afraid. But yeah, certainly the market reaction earlier this week, I think, was really a result of, the return of the potential return of Libya barrels, kind of supercharging what was already some underlying bearish sentiment on the demand side, as Neil and Vandana rightly point out. Especially weak China data coming in on the PMI front, weak US data on that front as well. And as you point to as well, OPEC Plus seems to be committed to bringing back some production from the beginning of next month at least. The default as it stands is that OPEC Plus will ease their production cuts from October as the first step of a plan that they say will add 2.2 million barrels a day back to the market by September next year. Nobody, frankly, expects them to bring the full 2.2 million barrels a day back. The market simply does not want that. Markets already are starting to look into 2025 and they're not really liking what they're seeing. Again, that's one of the reasons prices have been weak, that they see pretty, steady as she goes picture on the demand growth front and fairly robust supply gains coming in as well. So for OPEC adding that much by 2025, that's really unlikely to happen. But, they've said that they could pause the process, they can reverse it if they want to. And so people have really circled kind of the first week and a half of September in their calendars for quite a long time as the last point in which OPEC Plus could decide not to bring back barrels in October.
And your thoughts on that?
All the conversations we've been having are that, they are committed to this for now, at least. That October tranche is going to come in. Likelihood is that they're going to continue with that in November and December as well. Although, of course, if the situation really goes south, they could just bring back the first month of that and call it quits on that front. But as for now, it looks as if, increased production from October. And that's, again, one of the issues that has really been feeding into some of the pricing concerns over the last few days.
Vandana, again, sort of looking at this overreaction. I mean, typically when we've seen prices get to these levels in recent years, OPEC Plus haven't stayed on the sidelines to wait for further falls. But the overreaction theme, China's August imports were estimated at back above 11 million barrels, although they had dropped under 10 in July. But back above 11, where they've been for much of the year, there or thereabouts. China still has a decent heartbeat. We had reports last week out of the US that the third quarter the second quarter GDP numbers out of the US were 3%. The US economy still near full employment here. Where is all the weakness coming from?
Yeah, interesting. So let's talk about the China heartbeat, perhaps on life support, Sean.
I mean, they're striving for 5% growth this year. And that's their target.
Which by Chinese standards isn't great, right? And if you look at, and again, also with the caveat that it's a 5% official number, which is very hard for any independent outside estimates to concur with. But let's just go back to China for a second and then talk about the US. I think both are very important. And Europe, of course, the third prong. In China, if you looked at the imports on a Jan to July basis, I'll get to August, they were down 4% year on year. Again, going by China's norms, that is quite worrying in terms of Chinese oil appetite. Now, so you have to ask yourself, how many people are going to get excited about Chinese economy or oil demand finally getting into a jump phase just on the basis of a single number from August? I would wager that probably not many. I think the general consensus view in the market remains that China is struggling. Getting momentum back into its economy is going to be an uphill struggle. If you look at the US, and one of the reasons I said yesterday was a panicky reaction, exactly as you say, Sean, 2.8% economic growth, that's not bad. And when and how can you overnight go from being optimistic about a resilient consumer demand in the US, about 2.8% economic growth, to suddenly panicking about recession? I mean, this is bipolar behavior, isn't it? So that's the reason I thought So another reason, had the PMI data, and clearly investors, as I said, have become oversensitive to US data, and especially any signs of macroeconomic weakness, especially as they get closer to the Fed meeting, right? So had the PMI data not come out that bad, or even a little bit better, I would guess the sell-off wouldn't have been as bad yesterday. So one of the reasons I feel it's important to recognize this as panic, not a very rational market reaction, is then to be able to extrapolate it and say that, is this now the start of a continued downward spiral? And I would think not. Of course, a lot depends now on whether the Fed makes the investors happy or not. We'll know in a fortnight's time. But until then, I do expect the markets to be extremely jittery. There's a lot of speculation and recalibration of bets going on. I mean, I was looking at, just throw out some interesting numbers there, and then you can carry on. Is that as of Friday's market close, Sean, the bets on the Fed cutting 25 basis points at its coming meeting versus 50 basis points, as some of the optimists or hopefuls are expecting, was 70-30. 70% were expecting or hoping that if the Fed cuts 25 BPS, that's good enough. Yesterday, that ratio had changed to 59-41. So you could argue that 41% either are betting or hoping against hope that the Fed takes a much more drastic cut to the interest rate. So that's why I think it's an environment of great flux and nervousness. And I believe crude is just going to get carried along for the wild ride.
I mean, Neil, on that's sort of my next question. Is it crude? I mean, we didn't really get caught up on the upside, right? We see equity markets hitting record levels all over the place consistently, but oil not so much. But on the downside, is oil getting caught up in this sort of turbulence around this tipping point of change for the Fed, and whatever relevance that may have or not for oil markets, it's just getting caught in this bearish tsunami and not necessarily particularly relevant to the outlook for oil demand?
Well, personally, I think it is far more, the oil price is far more tied to the fundamentals of the oil market, frankly. I mean, if the Fed cuts interest rates by 25 basis points, that's hardly going to move the dial significantly. 50 might be obviously a bit more significant. No, I think as far as oil is concerned, to me, it is very simple. The demand prospects, the growth in demand we've been expecting in 2024, having started out consensus amongst analysts, forget the IEA and OPEC for now, consensus amongst most independent analysts is that we get demand of about 1.5 million barrels per day, give or take. And supply increasing roughly, non-OPEC plus supply increasing roughly the same amount, probably a little bit less. As the years gone by and real data's come in, we've found that growth has just not materialized. And we are closer now to a 1 million barrel a day increase in demand. However, on the other side of the balance, the supply has continued to grow. And to me, it's actually quite simple. The environment is hugely important. But in the United States, for example, we were reading this morning, I think in the FT, about US gasoline prices, which are, I forget, they're the lowest since something or other, but they're pretty low. They've been coming down, and that will obviously be important in the run-up to the US election. So I think really we are in a situation where we do not have enough demand growth set against the availability of supply. And finally here, political or geopolitical premium, which was very fashionable a few months ago. That was all the rage because of the terrible events in the Middle East, the continuing worries over Russia-Ukraine. Well, essentially, there is no geopolitical premium because nobody seriously believes that the Middle Eastern situation is going to escalate to such an extent that it would drastically impact oil supplies. And the Russia-Ukraine situation has sort of settled down into a fairly ghastly and grim long-term slog. So there's no geopolitical premium to support things. The Libyan interruption potentially could have been significant, but I think what we found in the past history of Libyan supply interruptions, which do tend to occur for various reasons from time to time, is that they tend to be settled. And the reason they're settled is that whatever differences the two governments in Libya may have, one thing they all agree on is that the only game in town for Libya is oil receipts. And, they cannot afford to have an interruption to supplies for any significant period. So Libya has faded from its brief moment in the spotlight as a potentially bullish factor. And we come down to the fact demand growth is much slower than we thought earlier in the year, and the supply picture has not changed drastically. And for OPEC, okay, OPEC Plus, if they're going to allow more oil back into the market in October, well, if they do go ahead and do that, and there is nothing on the fundamentals front that's different from what we're looking at today, it is difficult to believe that anything other than the price slipping further will be the outcome. And, those producers, Saudi Arabia, but the most prominent amongst them, they need revenue. And they are not in a position, I believe, to withstand a significant slip in the oil price down into the 60s for Brent, which is a possibility.
Jamie, on that point, I mean, you seem to indicate in your earlier comment that OPEC Plus are actually the specific countries that are in the group that are actually adding production from next month, which are only a handful of countries, that they are sort of locked into this decision, regardless of the background noise at the moment, for perhaps other reasons. Your thoughts on that lock-in, regardless of the price format at the moment?
Thanks, Sean. I'd say that one of the big issues that we haven't touched on so far yet is compliance from within OPEC Plus. And we saw last week, a big delegation from OPEC led by the Secretary General going to Kazakhstan and Iraq, two of the key countries involved in the voluntary cuts, where compliance has been less than adequate, shall we say. And the mood music that we've been hearing, both from within OPEC and from within Iraq in particular, is that there really has been some movement on improving compliance from within these countries. Iraq, it seems, has been shown the light. They understand now that poor compliance from their perspective, isn't just going to simply boost Iraqi revenues. It risks undermining cohesion for the group as a whole. And once that happens, other countries start to slip on their compliance, and Iraq gets hit economically as well. So it really is in Iraq's best interests from a revenue perspective to at least improve their compliance. And when we look at the numbers, Iraq's been overproducing by more than 200,000 barrels a day recently. So if they start to bring that down even cut by 100,000 barrels a day, that offsets an awful lot of the gains that we're going to see from October from starting to unwind these cuts. So if we do see improved compliance from Iraq, from Kazakhstan, from Russia, you could kind of start to see that netting off against the voluntary increases. And so there you have it. You have Saudi Arabia, the UAE being allowed to increase their production. They don't get hit too much by revenue loss, as we're not actually increasing supplies to the market.
Vandana, just picking up on that, the earlier point about Chinese appetite, demand. I mean, you have two things. Obviously, the macroeconomic outlook for China may not be as what it has been in previous years, and that's clearly been the dominant narrative this year. But there's certainly been buying moments when prices have been right, and we saw the August imports hitting 11, and that, some indications could have been to China once again taking advantage of lower oil prices earlier in the summer. Your thoughts now, again, at even lower levels, Brent at 73, we've got WTI dropping below 70, that typically the Chinese like to buy at these opportunities. Your thoughts on that, particularly as we are now into that sort of delivery ahead of the Chinese New Year, that this is a window where the Chinese would be buying anyway, and at these prices, we could see a take up there.
Yeah, indeed, Sean, and probably to some extent that argument extends to the rest of the world, and especially emerging Asia, which is the main driver of oil demand growth. As prices drop, appetite should improve. But I think the question here is what the market is balancing is that even if China comes out to buy additional oil, and we do know a couple of months ago, the government did mandate state-owned oil companies to stockpile, I believe it was 50 million metric tons or something over the next 9 months. So they will grab some barrels from the market. But the question to my mind is it going to be big enough buying to offset the sluggishness that we are seeing in the rest of the world? And I mentioned earlier, it's not just China. Market participants are looking at what's happening with regard to demand in the US and Europe as well. And if you look at US, yes, year on year, the figures come out maybe flat, slightly better. Compared with 2019, the US oil consumption is almost 1 million barrels per day lower. Europe definitely way past its historical peak oil demand. So, when you look at it in totality, and of course, people throw in India into the mix as well. Indian demand has been growing quite strongly, 5% year on year. In terms of absolute incremental demand, 5% growth in India amounts to about 250,000 barrels per day. Had China been growing at 5% demand, it's 750 or 800,000 barrels per day. So big difference in the scale there. If I may, Sean, just add on
Please.
to the OPEC theme that Jamie's been discussing earlier. Yes, I think the market is going to be, and we all do need to be focused on, is it possible that OPEC Plus will review and revise its decision to bring back the oil? But I think it's important to see this in the context of the longer term strategy. If you look at OPEC, just OPEC members, not the wider OPEC Plus, today they are pumping collectively about 2.2 million barrels per day less than what they were pumping in 2019. So compared with pre-COVID year. Over the same period, if you compare what has happened with the production of, let's just take these four Western producers together, US, Canada, Brazil, and Guyana, these four over exactly the same period have increased their collective production by about 2.3 million barrels per day. So, what it boils down to is, again, as OPEC Plus members look long term, they look at the demographic shifts, China probably coming close to peak demand as well in the next couple of years. They look at economic shifts, again, China pivoting to less economic intensive activities. And they look at energy transition shifts. The window for OPEC Plus members, especially the ones that are sitting on spare capacity, the few that are increasing capacity, the window for them to monetize that oil is closing very, very fast. So again, I would encourage our viewers to keep this as the broader context. How long, you have to ask yourselves, how long can OPEC Plus continue making these sacrifices and having a lot of the other non-OPEC Plus members piggybacking?
Well, that's certainly been a question for a number of years. And I suppose every time we have moments like this, it becomes very pronounced. Let's go to the survey question, which is obviously tackling the theme of the morning here. Oil has now wiped out all of this year's gains. What is the main trigger? The announcement, obviously, ahead of the summer that OPEC was to raise supply from October. China's weak demand. I mean, 11 million barrels a day is certainly on the lower end of the range of imports. But if they were to hold 11 over the next few months, that would be, healthy enough. Feds to start cutting. It seems to have put everybody into a bit of a wobble. I thought that was meant to be good news. I mean, Fed reducing the price of money, increasing economic activity. U.S. economic slowdown. It's hard to see it, but there is some signals behind the sort of the fog that there are some indicators that economic activity in the U.S. might be slowing, unemployment might be growing, which seems to be the trigger for the Fed, is more of their employment mandate than their inflation one. So your thoughts, what is the main trigger? You'd say all of the above to a great extent, but what is the main trigger? Neil, I mean, one of the sort of, as you mentioned earlier, the overarching sort of factors or pillars in this market, as always, and this year has been the geopolitical events, the risk that they present, and clearly they are not theoretical, they're very real at the moment. We're seeing a ship in the Red Sea literally burning, an oil tanker, and attempts to salvage it. And if if that ship does become unsalvageable or does break up before they can salvage it, and you've got 1 million barrels of crude oil in the Red Sea, and that's a whole other level of challenge for those waterways. So there's some, significant, I mean, Ukraine and Russia does look like it's boiling up to a new level of conflict. So where are we at with the geopolitical issues that could elevate this market? One event and you could spike, but how vulnerable is this market to that geopolitical risk elevating at a moment's notice?
Well, Vandana nearly triggered me a moment ago because she used another P word.
Yes.
And the one I dislike most of all, which is peak, P-E-A-K. But I
peak.
Won't focus on that just yet. But as far as geopolitical is concerned, I mean, coming back to this range of issues we've got around the world. I mean, Russia, Ukraine, yes, it seems to have gone off in a different direction, with Ukraine taking the fight literally to Russia and into Russia. And we've seen in recent days a sort of new wave of attacks by Russia using drones and other missiles into Ukraine. But, it seems that the conflict seems to have these sort of ebbs and flows. I mean, there's more intensity, then it seems to quieten down. But the fundamental picture doesn't change. As far as Ukraine is concerned, Russia needs to get off their land. And the Ukrainians are having some limited success in taking the fight to Russia. But it's not net. It's not really going anywhere. And as far as the Middle Eastern tensions are concerned, yes, of course, it remains a terrible situation nearly a year on from the October the 7th attacks. But I think we're realizing that it is in everybody's interest, not least Iran's, not least the interests of the United States, and of course, other Middle Eastern energy producers. It is in nobody's interest to see an escalation of conflict in the region, which would lead to actual cutbacks in supply. Now, the tanker that's on fire now, yes, of course, that's a terrible thing. And if it does break up and if it does dump 1 million barrels of oil into the sea, that is an awful thing. But quite frankly, in the great scheme of things, it's more symbolic in terms of its importance than real. And, I repeat my point from earlier, that there is no real significant geopolitical premium out there, I believe, in the oil market. Other sources of tension, the US apparently going to reapply some form of sanctions against Venezuela after the stolen election. But, when you look around geopolitically, in terms of actual impact on supply and likely actual impact on supply, I think it's pretty limited.
Jamie, looking at obviously a lot of focus on the crude oil outlook and demand and supply of that, where are we at with products, particularly from the perspective of the Gulf oil producers who've now, quite significant product exporters in the last year, adding over 1 million barrels of extra refining capacity in the region with a lot of high-end quality products. What's the outlook? How is that looking versus the crude?
Hi, Sean. Yeah, the Gulf states, they have an awful lot more flexibility now when it comes to selling their oil on the market. They can target the more basic traditional routes of going down the crude oil supply primarily to Asia, or they can pivot to the refined products. And they have some of the most advanced refineries on the market at the moment. Duqm refinery in Oman can pump out a lot of high value liquids, gasoline, diesel in middle distillates in particular, also pumping out a lot of naphtha. And longer term, frankly, I think we're going to see the Gulf possibly pull back a little bit from exporting the sort of volumes of refined products that we're seeing at the moment, as they start to add more in the way of petrochemicals facilities onto these. So if we look at Al Zour, we look at Duqm, which are the two most modern, the two newest refineries on the market, at least. Both Kuwait and Oman have very ambitious plans to add petrochemicals facilities to those two. Saudi Arabia as well, looking to add petrochemicals facilities to their existing refineries and possibly go down the direct liquids to chemicals route as well there. So I think interestingly, this could be a bit of an interim phase where we see the Gulf being a major supplier of gasoline, naphtha, diesel to global markets. We could see them pivot even further down the value chain into petrochemicals in the years ahead. I'd just like to touch on the issue that Vandana raised as well about this brief window in time that the Gulf states have to capitalize on their big oil reserves economically. I think that that's always a very live debate within OPEC is what's the best way to monetize that? Is it through volume? Is it through volume, or is it through prices? And if we look at Saudi Arabia in particular, obviously they've effectively producing 1 million barrels a day less now than they were, or rather in Q2 it was 1 million barrels a day less than they were 1 year previously. But revenues were up Q2 against Q2 the previous year. And if we look at against 2019 as well, revenues are still up against that pre-COVID level. It's really only when you compare it to 2022 that the revenue picture is looks a bit negative for Saudi Arabia. Obviously, that's down to the cuts, and you can't just keep on continuing to cut to prop up the markets, which is why the debate is as live as it is. But so far, the balance has been quite good as far as the Saudis and the Emiratis in particular are concerned.
Let's just wrap up, give Vandana the last word with the survey result. Vandana, so OPEC plus to raise supplies getting the most attention in this room, and we'll post that question on social. But I wanted to get your thoughts, as you will be hosting half the energy markets world in Singapore in the coming days with APEC annual gathering, which is not an insignificant moment on the calendar year. But my question is, what's the possibility that that scale of gathering of stakeholders in the energy markets could sort of define a new direction for the oil market, either reverse this bearish trend or sort of accelerate it further? Your thoughts on the mood in the room going into APEC?
Yeah, thanks, Sean. I'm really looking forward to next week, especially because of the past few weeks' turbulence in the oil markets. I think it's the rooms and the receptions are going to be absolutely buzzing. Just as in your survey results, we'll probably find participants, analysts quite divided and spread over a big range in terms of what are the main drivers into Q4 and 2025 and their outlook. I think especially we started this year on a much more optimistic note for oil bulls. We seem to be ending it with oil bears in charge. So I think that sort of tug of war will be up for discussion. Very quickly, I'll just expand a little bit on what Jamie said about OPEC plus as well, is that absolutely I agree with his point about the Saudis and balancing value versus volume. I feel there's also a tension which will remain in place as long as OPEC and OPEC plus exist between the Saudis and what they want to do, and countries like Iraq, UAE, Kazakhstan, who want to increase their capacity, who have plans to increase their capacity, and perhaps at some point may diverge, may not agree with the Saudi point of view, at which point what happens to OPEC plus is the big question. I'll leave it there.
Let's leave it there because we've run over time, which we're doing a little bit this week, but maybe that's just the nature of being back and having a lot to say. We'll wrap it up there. Jamie Ingram in the UK, Neil Atkinson in Paris, Vandana Hari in Singapore. Really great to have you back and have your insights at this critical week as it's turning out, and look forward to seeing everybody soon again. All the best. Thank you.
Thank you.